Subclass 2.9, Short-Term Reinsurance Policy, Part 2. Methods of reinsurance. There are two basic methods of reinsurance. The one is facultative reinsurance, and the second one is treaty reinsurance. Facultative reinsurance. So facultative reinsurance is the oldest form of reinsurance. Having accepted the risk, an insurer may decide to pass some of it to another risk carrier. So, for instance, your insurance company will take the small things as risk, but the bigger things like your house or houses or block of flats, they will rather send for reinsurance, that they don't take that big risks. So to do this, the insurer will approach the reinsurers either directly or via a reinsurance broker. All the relevant information concerning the risk will need to be presented to the proposed reinsurers. So in order so that they know what they're in for and that they take the risk for that. Treaty reinsurance. A treaty is a formal, legal binding agreement. Under this method, an agreement is made between an insurer and a reinsurer or reinsurers. The agreement allows that an insurer will cede and the reinsurer will automatically accept all reinsurance which are offered within the limits of that treaty. So the insurer will cede to take risks for your house, and then the reinsurer will take over according to that agreement. Then when we look at pools, it's not the pools where you swim in, it's a different kind of pool. So now you know two pools. This pool is something else. The principle of an insurance or reinsurance pool is that all the members put their premium for a particular risk into a common fund. So they share that common fund or pool. They then share the aggregate claims arising either in the same proportions as their premiums or in some other pre-arranged manner. Any profits, losses, or expenses are then shared in the same way. Underwriting pools. Smaller developing insurers which wish to enter a new market, class, or type of business may have neither the expertise nor the necessary capacity to establish a sound foothold. So people that wants to start their own short-term insurance company, they don't have the funds, although they might gather 10 million or 50 million rand, they cannot take all the risk at the beginning. So that's hence they're getting reinsurance people for the higher risk things. Yes, and all those the big insurance companies started small. Our insurance also started out of a house with the husband and wife team who started that. And look where's our insurance today. The same with King Price Insurance and all the others. They start small, and then they start to grow. They may therefore form a pool represented by an experienced underwriter in the chosen field of development with sufficient collective capacity to accept competitive lines of business. And then you look at facultative obligatory treaty. Now, we said there are two reinsurance companies. There's facultative, the oldest one is, and then treaty. So facultative obligatory treaty is basically considered as a combination, a combo of facultative and of treaty. So if you look here in the first bullet, it says facultative obligatory reinsurance arrangements combines. You see, it's a combo. It combines some of the principles of both the facultative and the treaty methods of reinsurance. So it's not all of them, it's just some of the things are overlapping or combination. So like the surplus treaty, the capacity is generally a multiple of the cedant's net retention. The big difference between the two is that under the latter, the cedant has no compulsion to cede business. So the last one, the sedant, does not have any compulsion to seed this business. It does not have to seed it. It can if it wants to. The risks ceded to a facultative obligatory arrangement are likely to be both fewer and larger than those ceded to a surplus treaty. This results in a less well-balanced portfolio of business for reinsurers. Under a facultative obligatory treaty, an insurer has the option to cede business to reinsurers. So they can decide what they want to cede and take over to the reinsurance company and what not. It is not bound to cede under the treaty. So they have not need to cede certain elements. They can if they want to. And this is where the facultative element of the name of these treaties arises. The insurer has complete freedom of choice in cessions, just as it would have under a facultative arrangement. Facultative obligatory treaties provide an insurer with considerable flexibility. Reinsurance commission. Reinsurance commission is a financial advantage arising out of a reinsurance business. Insurers benefit from contributions by reinsurers towards the acquisition and management cost. Reinsurers acquire business without the expenses of underwriting primary accounts. So reinsurance commission usually applies solely to proportional business, which is why it is considered here. So they are not responsible for the whole business, but just for a certain portion. Profit commission. Insurers are entitled to some compensation from reinsurers for a disparity in workloads arising from the account. This is the principle of reinsurance commission. However, too high a level of flat rate commission can generate problems for the reinsurer. One answer to do this difficulty is the use of profit commissions. Then we look at sliding scale commission. A sliding scale commission is another technique which attempts to maintain a reasonable relationship between insurers and reinsurers as far as payment of an equitable commission is concerned. This is an alternative form of profit sharing whereby the ceding commission is varied according to the long risk ratio experience, of the loss ratio experience of the treaty. Loss ratio is the claims expressed as a percentage of premiums. So the insurance company got a lot of premiums, but they have to pay claims out. Now that's money out of the bank, so that's their losses. And there's a ratio between what you get in, the premiums, and what you have to pay out. Loss participation. A loss participation clause, also known as the malus clause, is a form of reverse profit commission. Under this arrangement, a share of losses under a proportional treaty must be borne by the insurer in the event that the loss ratio exceeds an agreed percentage. The insurer's share of such loss will probably be capped at an agreed maximum amount. They will take losses up to there and then they will stop. Proportional reinsurance. In non-proportional forms of cover, the insurer and the reinsurers do not share each loss in fixed proportions and may not share in some losses at all. It will bear all losses up to a certain figure. Reinsurers will deal with the balance of any loss above that figure, usually with an upper limit for their own involvement. Working excess of loss. This term is usually applied to that layer of excess of loss reinsurance where a number of losses are expected each year. A working excess of loss arrangement is usually placed within the reinsurance within the reinsurers by means of a treaty. However, it can also be a facultative arrangement. Maximum amount. The insurer will decide on the maximum amount that they wish to pay in the event of a single loss. This is called the retention. Any losses that are less than the retention are retained by the insurer and the reinsurer will not become involved. The reinsurer will only participate for those amounts in excess of the retention. So this retention is sometimes referred to as the deductible or priority. Catastrophe excess of loss. This type of reinsurance is arranged to protect the insurer against a major loss arising either by way of an accumulation of losses from one event or from one single large loss. In South Africa, the Natal floods and more recently the Cape storms are good examples of events that led to accumulation of losses from one event. The same as the lootings as well a few years ago in Natal and Natal Midlands and so on. All the towns and cities and shopping malls that was looted. Also big losses for the insurance companies. Stop loss insurance. This type of reinsurance is sometimes referred to as aggregate excess of loss and excess of loss ratio. It is designed to protect a class of business from severe fluctuations in a result. The reinsurer will not be liable until the loss ratio for the year reaches an agreed percentage of the premiums. Thereafter, the reinsurer is responsible for all losses up to the limit of the treaty. Aggregate excess of loss. Aggregate excess of loss reinsurance works on the same principles as stop loss reinsurance. Instead of representing the amounts as percentages, however, cover is expressed in actual monetary amounts. Both methods contain the reinsured's total retained loss cost. Risk attaching, losses occurring, and claims made. Excess of loss contracts are arranged to protect a whole account for a period of time. One important consideration is the definition of precisely when and how the reinsurer is going to be liable in respect of losses. It is very much in the insurer's interest to ensure that its reinsurance coverage provides for adequate protection relative to the underlying book of business. Problems would be caused if there were any gaps or overlaps in the reinsurance protection, and then might then cause you not to pay out any damages or risk. And thank you. That is the end of this whole class 2 and all the subclasses. If you've got any questions, you know what to do. Good luck.